My name is George Bowling. I teach economics at St. Charles Community College in St. Charles, Missouri. Mr. Chairman, my question is, according to what I've been reading recently, there's a conflict related to what banks should be doing in the economic downturn. Some people say the banks should be raising capital in order to make them stronger. Others say the banks should be spurring the economy by taking on more risk and lending more to small businesses and households. What should be the goal?
So the question is about, is there a conflict between banks building up their capital, becoming more stable on the one hand, versus helping the economy by making loans to small businesses and consumers and so on the other hand? It's our view at the Federal Reserve that there really is not a conflict between those two objectives. And the reason is that what banks do for a living, so to speak, what banks do is make loans to good borrowers. That's how they make their money. So by maintaining relationships with their borrowers, by making loans to good borrowers, that's how they build their profits, that's how they build their capital. So we think it's good business. We think for banks to lend. We think it's good for the economy for banks to lend. And so from our perspective, as you know, the Federal Reserve is not only the monetary policy agency, we also have a very substantial role in regulating the banking system. So what we tell our bank examiners who go in and look at the books of the banks is we say, take a balanced approach. And that what I mean by that is that you don't want to tell banks, no, you can't take any risks, don't make any loans, just curl up sort of into a little ball and just ignore the rest of the world. We don't want that. Nor do we want them to make risky loans. We don't want to make loans that are not going to be paid back. That's certainly not what we want either. What we want is an appropriate balance. We want banks to make good loans to good borrowers, and that includes, of course, lots of small businesses who have been through a lot through this recession, and they're still there, and we need them to grow. We need them to hire as part of our recovery. So again, there's not really a conflict in our policies and what we tell our examiners and what we tell the banks is we just got to get the right balance. We don't want to be excessively risky. We don't want to lose money. We don't want to lend to people who can't pay back, but we do want to make good loans to people who can pay back, and that means a lot of small businesses, a lot of households who have shown that they're responsible and that they're able to repay what they borrow. And again, that's not just important for those individuals, but it's also important to get our economy going, because certainly one of the reasons that growth has been sluggish, going back to the earlier question, is that small businesses in particular, not being able to get as much credit as they would like, are not being the engine for job creation that they typically are in a recovery, and that is one of the things that's holding us back.